next speaker is going to be Bart Markus of Wellington Partners. Really smart venture capitalist.
Exactly. I mean, the venture capital part is true, of course. They're really smart, I don't know. So I was asked to talk about how you get funding in a clean tech company, which I think is probably many of you are dealing with. How many of the people in the room are actually entrepreneurs that are running a company or involved in a company? That's good. And how many of you actually do have venture capital already invested in your company? So I think it's probably, I don't know, about a quarter of the people that have a company here have actually got venture capital in the company. And I think it's a bit of a symptomatic thing for what I will describe here. 3-4 years ago, 5-6 years ago, also because of a lot of the incentives that we talked about before, Cleantech became a really big hype, and a big part of the investment community flooded into the sector, and there was a lot of money available for a lot of companies, and getting funding for these companies was probably relatively straightforward. Today, I think that picture has dramatically changed. I would say Cleantech is no longer as hot, and it's very, very difficult to get funding in these companies. So I'll talk a little bit about some numbers and then try to extract the so what, like what can we do and what can you guys as entrepreneurs do to get money into these companies. So first some numbers. This is in Europe, the amount of euros that have gone into clean tech companies, early stage clean tech companies over the past years. Won't be a surprise to anyone. This is actually it's all data from the Cleantech group. So it's dramatically going down. And what they also tried to do is they looked at how much money is there available in venture capital funds to be put. So the first chart showed you what actually has gone in. This is the amount of money that is still there, that what we call dry powder, the money that can be deployed in these companies. Also going down significantly. And what, of course, also we need to realize is that many of these people that have dry powder in their funds, like ourselves, actually have a portfolio of companies where they already are committed to as well. So not all of that dry powder is available for new companies. So that's pretty bad. So let's look at the other side of the equation. And you look at, here are the companies that have been started up and which received a significant amount of funding. If you take all the clean tech companies that have been started, it's even a bigger number, but the picture is clear. You know, it's an increasing amount of companies in the landscape. What this does not account for is the amount of companies that have actually gone out of business, because there's not so much reliable data, so it's probably a little bit less than that, but you have, on the one hand, you have the funding available going down. On the other hand, you have the competition for that money going up. That creates a very uncomfortable situation for most entrepreneurs and frankly also for most venture capitalists that are in these companies. So as a result, you basically see two things happening. You see the venture capitalists all running away from the sectors. Many people going back to more classical, more traditional areas of investing. There's a number of clean tech dedicated funds which will always invest their money in clean tech, but I'll be totally honest. I mean, if you look at a fund like Wellington, where we have in the past fund, we put a third of our capital, 30% of the capital we put to work in the sector, in clean tech, and 2/3 in the internet. In the new fund that we've just raised, it's actually focused only on ICT, and we're contemplating to raise a specific fund for clean tech. We're not even sure we're going to do that. So, I think that we are one of the people that are suffering from, too little money going in there. And the reserves that we have in our portfolio or in our funds, we deploy them towards the companies that we have there. And even if you look at that, you look at the portfolio of companies that we have in our fund, we have to already make decisions like, here are the companies that we will back, and here are the companies that we can't back, because every company needs more money. There's no external money available. So it's a pretty drab picture, I think, for you guys as entrepreneurs. So what's the reason for that? So do we just say, okay, the markets are to blame and they're stupid, they should understand that it's all about renewable energy? Well, let's do a comparison between internet companies and clean tech companies. So I would also, I took the Berliner, the Brandenburger Tor, right, it's called, I think this thing is, you invest in an early stage internet company. It's like taking a walk through the Brandenburger Tor, so to speak. You know, you have a small amount of money, you put it into a company, you wait a relatively short period of time, and then you know if you have something that's gonna, you know, be a business or is not gonna be a business. If you then have something that's a business, there is actually plenty of follow-on capital. So the model as an early stage venture capitalist, where you put a little bit of money up front, you get a relatively high ownership, 20, 30%, and after that, you may follow on with a little bit of money, but most of the money comes from other people at higher valuation. That's the idea of early stage venture capital. It works pretty well, and then when you have these companies that are good, there's actually plenty of people that will buy these companies off you at very good multiples. I mean, I think everyone's pretty aware. Now then we look at the Cleantech companies, and I would say instead of taking a walk through the Brandenburger Tor, it's like going into a dark tunnel of, you know, 6 or 7 years, where you, as a venture capitalist, you invest your money in a company, you go into a product development phase, which just simply takes time. If you do a hardware development, you can't do that in 6 months. So you come out of that tunnel costs you a lot of money, 30 million, 40 million, 50 million, and on the end of that tunnel, hopefully, you'll come out with a product and you'll come out with a customer. And of course, in the old model, we as a venture capitalist, we put a couple of million into this company, and in our voyage through the tunnel, we open a little door on the side, and we get a bit more money from, you know, someone else that puts it in at a better valuation. Well, actually, no. There's no door to open. There's no door to knock on. There's no one that's going to put money into these companies. And for the few companies that do, instead of getting it at a much better valuation, I mean, I have one of my companies, I won't mention the name now, but which actually is a really, really good company. We just come out of the tunnel. So we're like, we invested in 2006 in that company. And we do the last round of funding, and we're closing that at a $100 million valuation for that company. So sounds pretty good, right? Well, actually, the company used $65 million to get to where they are. So the weighted post-money valuation is $85 million. So the guy that puts the money in today, in 2013, pays a, what is that, 13% premium over what I put in this company as an average valuation over the last 6 years. And then, of course, for that one company that makes it, I have 4 other ones that actually died along the way. So who's the stupid guy here? It's me. So this is what makes... And then when you have these companies and then you want to try to sell them, you know, if you try to sell a company to someone like a Google or someone like a Microsoft, you run into an organization which is very used to be aggressive, to be quick, you know, to understand whether, you know, this is something that they want to do in-house or whether, you know, they want to acquire something. So you can probably do, you know, from where you introduce your company to one of these big companies in ICT or in the internet, to an M&A transaction in, you know, we've seen ridiculous stuff happening as 2 months, more typical 6 months. Now you go and try to sell a company to, you know, Alstom or Siemens or, you know, Philips, you know, forget it. You know, these guys, they take years before they decide whether they want to buy a company like that. And even when they've decided that they want to buy it, you know, before they then convince the board, it's another year, you know, in the decision cycle. So very, very difficult market. So what, right? So why do I paint this very grim picture? What do you learn from this? So I think you need to, what I just painted is simply reality. So as an entrepreneur, you can either, you know, bang your head against the wall, or you can try to adopt what you do to that reality. And I think there's 4 things that I believe that you can do as an entrepreneur. And I'll give an example. I'll use 4 portfolio companies that we have as examples of how we've actually, you know, got these companies to do that. So the one thing is, in a market where capital is not the constraint, a startup company, time to market is the critical thing. So you optimize for time to market. In reality, here where cash is the constraint, you want to optimize for cash to proof point. You want to bring the amount of time. So you don't want to have a 7-year voyage through that dark tunnel. You want to have a, you know, 3 or 4 year voyage through that dark tunnel. You want to see if you can tap into other sources of capital. I'll talk a bit about that. And then, of course, as I just said, most of these guys are going to end up, of course, great if you could take the company public, but reality is that 90% of the exits are M&A exits. You better start working on your exit much, much earlier than if you're an internet entrepreneur here in Berlin Mitte, which knows that by the time he's got a company, the guys are going to probably be knocking on his door. So, limit the amount of money required to a proof point. So, the first thing is, if you're thinking about building a plant, don't. Figure out a way on how you can actually develop your company without putting an enormous amount of capex in there to build a plant, and optimize, as I said before, for the amount of capital that you need to show that you have a successful business instead of for the time that you have to show a successful business. An example is our company Orkan. I think Andreas is, I don't know if he's in the room, but he's going to be here at least. It's an organic ranking cycle company. One of the unique things about these guys is that they only assemble standard components so their factory is an empty space. All the stuff that they get from their suppliers is basically on credit of the supplier, so there's no working capital involved whatsoever. So even though that they sell a hardware product, there's no manufacturing capex, there is no working capital involved until you get a customer that actually purchases these things from you. And so I think it's a good example of a company where, when we looked at it, we looked at a lot of companies in that space. We said, shit, this is probably tough to do. But actually, they found a way on how to make a business model work where this company has raised a very small amount of capital so far, and probably doesn't need to raise a lot more money than that. And I'll highlight in each of these companies only the point on the slide, but obviously, so like an Orkan has actually signed up a big distribution partnership with one of the big German utilities, which is distributing their product for them, which again, it's a way to minimize the amount of capital that you need to raise because they don't need to deploy a big sales force. They actually have a partner that's deploying a big sales force for them. Bring down the time to the proof point. So we invest in a company in Sweden doing nanowire LED, and which ultimately will be a lighting application. And since it's a bit of a unique story, so since we invested in this company, we've actually brought the originally planned time for market entry forward, so we pulled it in by almost a year. So the company is actually going to be in the market with a product with customers this year. Originally that was planned for next year. That's not because they worked harder, but actually that's by picking a product for market entry that is an easier product to make than the ultimate product that they believe will, potentially open a much bigger market for them. So it's a staggered market entry approach to be able to get into the market a year earlier by doing a simpler product originally. So if you have no capital constraints, you probably wouldn't do that. You'd go straight for the home run, and you'd spend all the money. But in this case, it's important to get in the market really, really quickly. Another company which is, if you look at it, it's very, very capital intensive, energy storage. It's and storage company out of Israel. It's a flow cell based energy storage company. So to get that into the market, the amount of capital that you require just on building the first couple of installations, we're probably talking well north of 50 million euros in working capital to do that. I don't think in the current environment that is possible to do that. So what we did with this company, we kept the burn rate of the company very, very low. It's of course also Israeli, so they are, they know lean and mean in Israel, and so they have a burn rate of, I think it's like $150,000 a month. It's tiny, and they've now signed up their first customer, which is deploying the first product for the company. So it's in the order of magnitude of what I was just describing, so it's many tens of millions, which the customer is funding together with the company. So we probably took longer as a result than we could have, tried to put something in the market earlier ourselves, but would have had to put 30, 40 million in the company to actually do that. In this case, what we did is we said, no, we're not going to do that. We built a very small pilot installation to show that the technology was working. and then we actually got a customer to put a lot of money in there to deploy the first commercial implementation, which is they're starting to build this thing later this year. They literally just signed the contract 2 weeks ago. And then another good example of a company, Cavendish Kinetics. So not really a clean tech company, but I think a hardware company, so it illustrates the same problem. So they do chips that go into your cell phone and will make sure that your cell phone doesn't drop out of the network anymore as often as it does today. This is actually the company, that doesn't matter, that I was talking about before, where we're doing the last round of funding. They're now moving into the market. If you think about this company, we got the most likely buyer for this company is Qualcomm. They're the only guys that can actually pay up for a company like this. We got Qualcomm involved in this company 3 years ago. So they have been in this company on the table, actually as a strategic investor, and they know this company intimately, and it's very, very close. We're actually introducing 2 products in the market together with them. So if, we have the hope that this is actually going to be an IPO exit, but if it's not, then the buyer is already on the table. And these guys are so familiar with the company that it wouldn't need, any due diligence anymore. The guys know exactly what this is all about. So I think that is, for me, the so what, like what we do. And then, of course, as those of you that have listened to me before, you know that I always have this one slide in every presentation I do. It's my Cato thing, Ceterum censeo Carthago delendam esse, right? The Roman senator that at every speech in the Senate always used to end with, apart from everything I just said, I think that we should destroy Carthago. And at some point the Romans, without any apparent reason, went to Carthago and actually destroyed the city. So this is my Ceterum censeo. As a CEO of a company, here are the 4 things that you always want to do in your company. Create a culture where you have the right clock frequency in there, so you get people to act in days, not in months, where you have the dream team always, and keep changing your team, where you have a long-term strategy, but actually have a short-term action plan that's derived from that, which you execute on. And as a last point, which is in sync with what I've just been talking about, have a real bang for the buck culture. Money is a finite resource, in particular in clean tech, and so optimize what you do for the cash that you have. And don't think that, when I run out of the money, I'll find more money somewhere else. That's all I had to say. Thank you very much. And almost some time, right?
Wow, you saved us 1 minute. Which means you can ask him questions. Who has a question for Bart about this reality check, which is very important? I actually think this lack of capital is making the companies better because they are wasting less resources. Isn't it a good thing?
No, I'll be honest, I don't think it's a good thing. I do agree that the companies that make it through with less capital and come to the same outcome, obviously that's going to be a better multiple and everyone's going to be happier, clearly. Mm-hmm. But I think the lack of capital makes that the deals that the entrepreneurs can get from the little capital that's available is much worse. Mm. So I'm not so sure that the entrepreneur will end up with a big stake of the company compared to if you have a lot of capital available. So I think it's not so good for the entrepreneurs to have that. And secondly, I think there's a lot of companies that actually are good companies that just won't get funded and as a result won't make it. So I think there is a bit of a survival of the fittest. So I think there will be good companies created and they will make it through. But I think there's a lot of companies that would have been worth to be created, which are not created.
And did I understand correctly that this year and also last year you didn't make a new clean tech deal, but you focused in supporting your existing portfolio?
Correct. And not even every company in the existing portfolio, to be totally honest.
Yeah? So how many died?
We had one that we no longer continued funding. We actually, so there was a press release on it last week, right? So we had Agnion, which was one of our companies, which
really?
we did.
That's why Stefan doesn't respond to my emails? Kleiner Perkins was in with you.
Yeah, correct.
And they are going down? Are they already filing for?
We sold the company to someone that's actually got a good government grant to continue the company. So I think the company will continue, but we're no longer part of it.
Ah, okay. So you sold your stake. Did you
Yeah.
lose quite a bit of?
Yeah.
Okay.
Quite a bit.
All right. One question from Alessio. Wait for the microphone, please.
So, Bart, are you going to be investing in hardware technology in the future, or are you focusing on a wonderful e-retail, e-commerce stuff yourself? And how can you wake up in the morning these days and go excited as you always are and see new startups and working on your companies?
This sounds more like a question over a beer than a question in front of a whole audience, right? But no, come on, I'm a hardware junkie, and I get excited about these kind of companies. So I, as Bart Markus, will continue to invest in this kind of stuff, and we'll find a way on how to do that. That's the honest answer. I will not. You will not see me do the next Wellington investment in a social network. Wellington has always done the majority of our investments in, web, internet. It's always been like that. But I build up the hardware part of our business, and I think it's a good business, but it's a tough business at this point in time. That's the reality. But I'm not going to leave you guys alone. Don't worry.
Right. Bart, you said that it's good to have a quick proof of concept, and more or less that's the same we are doing. And it's sometimes hard then not to be confined on that quick proof of concept, but to show what's the potential of the technology. So do you have some hints how to do such a communication?
You mean to...
Just that's only the first proof of concept, but please, afterwards we go further steps, and there's the real potential.
So I'll use the example that I pulled up there on the time to market of Glow, where the customers that we are engaging with right now, they engage with us based on a roadmap. So we actually went to these customers and we said, here are the products that we will launch over time, and but here's the product that we want you to engage with us on this year. We think it's a good product. We know that you probably have alternatives, but work with us on that, and then we'll give you that over time. Now that requires more than a good sales guy to go to the customer and say, here's a catalog, do you want to buy this thing from me? It really requires, as a CEO, to sit down with the CEO of your customer probably, or with very high up people in the customer organization, and we try to help the company with that. But in the case of Glow, it's a very, very senior team that we have in there, and so they've done a very good job at that. But that's what, so you need to show a roadmap. And then PowerPoint is not enough in hardware, so you need to do a little bit more than just PowerPoint. So you need to come with prototypes, with proofs of concepts and all of that, right? And so it completely depends on the kind of company.
Yep, thank you.
Another question? All right. Thank you very much, Bart. I really appreciate your honesty. I think the honesty is very important, because that's why we come together here at Ecosummit. We want to learn from each other. And I think it's better and easier to learn if people are telling the truth and not trying to sell something which is not really true.